Right, hello and welcome. And in this video, we're going to be doing another weekly S&P 500 chart storm walkthrough. And just for a little bit of context, this is taking the weekly chart storm that I do on Twitter and just going through and adding a bit of extra comments and context on the various charts. And you can see the line there. This week, we've got seasonality, fund flows, and late cycle signals. So we'll get straight into it. And the first one shows you in the red line there the S&P 500 year to date against the average seasonal pattern over the 1990 to 2017 period. And you can see that I've also shown in the grey line what is the excluding 2007, 2008, 2009 period, just to strip out the impact of the financial crisis. And you can see there that the pattern's pretty much the same. And probably the key point there is just how this March through the sort of late May period is generally characterized by positive or bullish seasonality, and the period thereafter is not. And I think it's probably worth just honing in on that. I'm going to talk a little bit more about it in this one as well. We may as well go straight into this before we sort of sum it up. So the monthly statistical table here shows you not only the average return, which is basically what we're seeing in the previous chart, but also the proportion of times that it was positive, which is quite an interesting statistic. Also the best, worst, and the variation around that. And you can see that the percentage of the times that it was positive in April, 72% of the time returns were positive. So that's quite meaningful, really. Whereas some of the other ones, 56%, that's pretty close to 50-50 there. And even in the worst month, September, if you flip it, it was only 54% of the time that returns were negative, so only just over 50%, so really just 50-50. But anyway, April is basically the best month there. Second, it's first equal in terms of percentage positive. If you look at December, the also thing to note about December is that it's got a higher best and a lower worst return. And on that note, it's worth looking at that worst return, or the biggest drawdown column there. So, even though April has been the best month in history, there's been, at least one episode where it was down 9% in April. So, that just goes to that point that, seasonality is quite an interesting phenomenon, but doesn't always work, as we can see there. And similarly, when in September, which is the worst month, there was a time when it did 9% positive on the month. So, just a word of caution there, I suppose. If you think about this average line here, there's a lot of moving all around that average. But if you think about what else is going on and think about how we're just coming out of a correction here, and a lot of sentiment signals have been sort of reset, probably does pave the way for a bit of positive performance in the months, in the coming month or two. And there's a lot of background issues, such as monetary policy tightening steadily by the day. So the Fed has got quantitative tightening, it's implemented now, and it's on a plan to automatically increase across time, and plus rate hikes. And if you think about, there's already a seasonal bias downwards from that June to late October period. Could indeed well be that that's when the second test or second correction may make its presence known to us. So seasonality, interesting statistics there. On to the next one. This one here from Hedjopia. He's got some pretty interesting charts here, so I highly recommend that you follow that account if you're not already. And This one here in the green is showing you the rolling 12-month net flows from global investors, or offshore investors into US stocks, and it's been quite substantial flows over the last 12 months at 140 billion in the 12 months to January, and it's a massive reversal from we can see their net selling of 145 billion in the 12 months to February 2016. Big turnaround there. But as I noted in the write-up, and I'll put the link to the write-up in this video, but as noted in the write-up, we're looking at, looks like about 190 billion net inflows at the height of the dot-com boom. In today's dollars, that would be, almost 300 billion versus, 140. So you could argue there that there's still plenty of, it's not at such an extreme compared to where history is if you normalized it. And the same goes for, the peak of the 2007 period. And that's only if you, adjust it by CPI, where, arguably you should be adjusting it by, the pace of the change in the stock market. But anyway, it's quite an interesting surge, and I guess in the sense that it's not technically at an extreme if you think about where the previous two massive surges were in the late part of the cycle. It's probably more momentum information rather than contrarian information, so very interesting piece of context to add. The next one shows you the S&P 500 and the total of the Fed, ECB and BOJ balance sheets summed together. So it's basically, this cumulative effect of quantitative easing that's going on. It's one of those sort of dubious or, interesting charts in that, markets gone up fairly easily in the past without quantitative easing, and there's been a whole lot of other things going on in the background, such as improvement in the economics and improving earnings. So, it's not to say that that it's going up just because the central banks are buying bonds and other assets, but I would note though that it is quantitative easing is one part of the toolkit for monetary policy, and when monetary policy is easy, that's generally good for the economy, generally good for stocks, and when it goes the other way, it's generally bad. So, it's there's a lot of criticisms that we could levy at this chart, but there is some interesting aspects of it too. And a very similar kind of chart, but quite a power chart, I guess you could call it, is got here the bond index, the Barclays Ag, and the S&P 500. I think they might have actually changed the name of the Barclays Ag. I think Bloomberg might have brought those indexes off of Barclays, who plucked them from Lehman's during in the wake of the collapse there. Very interesting set of data that is, by the way. But anyway, so yeah, we've got a stock and a bond index, and you've got a few lines over here, and these are cumulative flows. So Fed, QE, share buybacks, all bond flows, and all equity flows, mutual funds and ETFs. So yeah, interesting chart. I've mentioned there that corporate buybacks exceeded retail fund flows almost 7-to-1, which it's an interesting statistic. But buybacks are basically they're basically dividends in disguise. So I don't know whether you there's certainly an impact of full force on the market, but I don't know if it's strictly apples for apples, but quite an interesting chart nonetheless. Interesting one here. This is the median net debt to EBITDA ratio for non-financial S&P 500 companies, and you can see there that it's at a record high. Now, a couple of things to note about this one. First of all, if you look at where we're at the moment versus back in the 70s and 80s, around that period there, interest rates were in double digits. And, they're still pretty high in the 90s as well. And whereas now you've got, bond yields have gone up quite a bit in the last few months, but they're still pretty low levels. So, you know, today's debt is not the same as yesterday's debt because it was more expensive to service the debt when it was, interest rates were in double digits versus the low single digits now. So, there's a certain, um, you know, you could potentially argue that while interest rates are low, that it's more sustainable to run these kind of debt levels. I guess the other thing is that as bond yields fell quite substantially in this period here, if you think about debt, I'm guessing that these guys have used mark to market valuations of debt, and if they have, then valuation of debt rises as interest rates fall. So, it may not necessarily be the case that they were, you know, leveraging up substantially more than they were in the 90s or the previous period. It may just be that interest rates or, the movement of the market has done a lot of the work in terms of lifting that level of the market value of debt. But it is a kind of almost a mirror image in some ways of the previous chart. If you have a big string of buybacks, and of course it makes sense to do buybacks if the company has got no better use of its cash, like if it can't think of any good ways to deploy cash in either organic growth, capex, R&D, or in M&A and other such activity, then buybacks probably make a degree of sense. Certainly, but they made a lot of sense when if borrowing rates, if the cost of debt is lower than the earnings yield, then it's pretty easy money to do that and kind of makes sense in some ways. Moving on to the next one. This shows you the household's equities as a proportion of total financial assets. And you can see there that it's approaching the dot-com peak levels. And, there's a couple of things to note about this. First of all, it doesn't necessarily mean that households are actively allocating. But then again, the counterpoint to that is that even if you're not actively putting funds into the market, your existing holdings, by not selling, by not rebalancing, you're effectively making a decision to stay long and to stay at higher allocations. But big point, very important point to make on this one is that it's just a percentage of financial assets. So this is not really an asset allocation weighting chart because it doesn't bring in any other household assets such as property, which is a pretty massive one. So it's not a complete picture, but even then you just look at that and it does as I said before at the start, it's one of those late cycle signals. And on to the next one is bottom up earnings per share estimates for Q1 2018. You can see there that the turn of the year was about then, and that's when we had this big jump up. And it's unsurprising, as such, to see that jump up because that's when the corporate tax reforms kicked in. And you can see the big one-off bump, and then sort of tapering off thereafter. And it kind of makes sense to see that surge in the market there. It gave the market that one-off bump from tax cuts, gave the market a bit of a sugar hit. And remains to be seen how things go from here. I mean, it's kind of hard to see given that bump there and given the scale's quite compressed. I mean, not compressed. that it was kind of in an upwards trend there, because there's a few interesting things. Well, I guess really three factors. It's a strong domestic and global economy, weaker US dollar, and improved commodity prices. These are three things that are very supportive for earnings in general. So, you know, if those three trends can continue, then, we might see continued earnings growth, not at the same pace, but continued earnings growth beyond the tax cuts. One of my favorite charts here from J.R. Ritter, the data, and I strongly recommend that you have a look at that data set. It's very interesting, very useful data set there. If you click on the link to the article that I wrote there, I've got the link to his stuff. Otherwise, of course, you just Google J.R. Ritter IPO, and you'll find the stuff. And anyway, this is showing you the proportion of IPOs with negative earnings, which is quite interesting, really. It's at the exact same levels at 76%, as it was in 1999. So, kind of makes one tempted to draw parallels between today's market and that market. And certainly there are, a couple of interesting parallels. I've heard a couple of people mention that, you could consider that cryptocurrencies are like the dot-com stocks, and we certainly saw a lot of speculative mania into that. And just broadly, back to that allocation chart, household equities chart, there are actually quite a few things that do look similar to back at that time. And yeah, if looking at the breakdown, I think we'll just quickly jump into here. It's Wix website, so it's a little bit slow to load. Might have to change that at some point. Anyway, looking at the breakdown, so I've got the breakdown here. So 97% of biotech IPOs were in the loss-making camp. Technology is in second place at 83%. And for all other companies, it was 57%, so just over half of all other companies, non-tech, non-bio, were also loss-making, and that 57% is actually the highest number on a record. So very interesting indeed. And the final chart, just a little bit of a fun one really, is showing the S&P 500 priced in Bitcoin. So S&P 500 divided by Bitcoin in US dollar terms. And I've had to show it in a log scale because it just looks completely unintelligible if you show it in non-log form. And yeah, well, now that the Bitcoin price has peaked and S&P 500 sort of having at least a wobbly uptrend, it's starting to claw back a bit of that persistent and substantial underperformance. And I will leave it at that point, and if you have any comments, questions, suggestions, go ahead and put them into the comment section below, and subscribe to the channel so that you don't miss out on any future updates.